In this week's update, a big picture perspective on where markets are headed. Gold breaks down, the necessity to be guided by the charts, and we'll have a look at the Bitcoin chart as usual. My name is Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. All right, look, it's been a tumultuous week, to say the least, and the big thing was the spike in the bond yields, which caused a mini correction in the equities market. So the question from here is where do we head going forward? So I want to take a look at what lies ahead. Now, this is at a big picture level. This is not what's going to happen in the next month or even 6 months. This is what's going to happen over, or is likely to happen over, the next 2 to 5 years. Now, this is not a prediction in any way, but it's always helpful to have some signposts that you can look for and then to gauge the market, how the market responds around those particular signposts. And that's the most valuable way to trade the market. So that's the context in which you should use these comments. I think there's a very strong probability that we're going to see markets split quite massively. We're going to see some stocks continue to do very well, and they're largely around the mega trends, the unstoppable mega trends that are going to continue no matter what, and the rest of the market. So I think we're going to see a lot of divergence. And the reason that I say that is that I think central banks over the last decade in particular, but over the last couple of decades, have subverted the normal economic cycle, the normal cycle of boom and bust. And this is an experiment like no other. I think people will look back in 10 or 20 years' time and wonder just what the heck was going on. But because the normal boom and bust cycles have been subverted, we're seeing excesses in so many areas. In the bond market, obviously, in the equities market, in currency markets, and now we've got the rise of cryptocurrencies, and you know, people are looking for alternatives to the traditional way of investing. Now, if inflation breaks out, then I think much of the market will derate. Now, the question is, will inflation break out? It's being predicted since about 2012 that with all the central bank stimulus, which is now greater than ever before because of COVID, and inflation hasn't broken out. And that was largely around technology, keeping the pressure off wages and making manufacturing more efficient. But at some point, this level of stimulus may lead to an inflationary breakout. And that's what's really the danger and what's concerning the bond markets at the moment, and why equities corrected back a little bit last week. I don't know whether we will get serious inflation or not, because the technology efficiency argument is still in place. But certainly there's enough stimulus being pumped into the system for that to occur. And we're certainly seeing that in commodities at the moment with base metals and iron ore and crude oil and all those commodities going significantly higher. Now, I think the mega trends are going to continue to flourish. I think that's a given. You know, 5G is not going to go away. Artificial intelligence, precision medicine, etc., etc. The electric vehicles, renewable energies, it's not going to go away. So those mega trends will continue to flourish. But the actual mega trend stocks, I think we're going to see large price volatility. And the reason that I say that is because a lot of these stocks are being priced on a new paradigm. The new paradigm being that we don't worry too much about earnings in the short to medium term. It's all about exponential, scalable global growth that would appear to have a high probability. And markets are prepared to pay up now for that, and to pay an excessive amount in some cases. Now, if you wind back 2 decades and we saw the emergence of Amazon and the Facebooks traded at extraordinary multiples, and people thought it was crazy. But it's turned out that those companies have grown into those multiples and have continued to go on and get bigger and better, and the share prices have continued to go up. So this new paradigm is not without precedent. There's certainly plenty of evidence there that the way that a lot of these megatrend stocks are being priced is not as crazy as it might seem. But I expect that what's going to happen is that there's going to be a lot of debate about whether that new paradigm of valuing stocks is valid or not. And so whilst the megatrends, the expansion of 5G, etc., is going to continue and it's almost certainly going to accelerate, I think what we're going to see is that stocks are going to fluctuate sharply in both directions as the debate rages on. So I think that's not a bad blueprint for what to look for as signposts over the next 5 years or so. So it raises the question, can we still make money in what might be, I stress, an index cyclical bear market? Now, as everyone knows, and I've been doing this for many, many years, we are now in a secular bull market, which started in 2013 and could well extend to 2030. But within that, we will get one, if not a couple, of cyclical bear markets. Now, cyclical bear market, think 1987, think 2016, and certainly we only lasted for 1 month, but we got a cyclical bear market in 2020 with the COVID crash. So the question is, if the index is going down by more than 20%, which defines a cyclical bear market, can we still make money? And the answer is absolutely, because of what I said before, and that is I think the market is going to start to split, and we're going to see the index might go down and the majority of stocks might go down, but some stocks will continue to do really, really well, and that's the ones that you need to focus on. Now, from my perspective, the sector selection is simple. I mean, I'm not going to cover it again. Everyone pretty much knows what these megatrends are. They're going to prevail, and I think they're going to expand at an accelerating rate. It's going to be an extraordinary 5 to 10 years to watch. It's going to be very exciting. So the sector selection is simple. Stock selection is going to be harder because there'll be many pretenders and there'll be many stocks that will get there and that will achieve their objectives and be able to achieve this exponential global growth. But unless you really do your homework, the average retail investor is not really going to know one from the other and is going to be guessing to a degree. So you need to make sure that you're plugged into a source of information that can differentiate between the stocks that are going to make it and the stocks that aren't. And I think also it requires a different mindset. I get a lot of questions from members and non-members that start with something like, I want to hold this for the next 5 years. And that seems to be a mindset. And I understand that. It fits in with our psychology. We like to feel that if we give something enough room to move and enough time to play out, that it will all be good. And it's all well and good to go into an investment with a mindset that I'm going to hold it for 5 years. But the problem is, in reality, when prices are volatile, and I expect that all prices are going to be volatile from here on in because of the stresses in the global system, that most people get cold feet along the way. So they might go in with the intention of holding it for 5 years, but when the price falls 20, 30%, they get cold feet and they sell out. So in reality, it doesn't actually work for 99% of people. And I've been working with traders and investors very, very closely and fielding their questions now for about 16 or 17 years. So I know clearly how people think and how they react in the market. And I've just seen it over and over and over again. So from my perspective, I would strongly recommend that you forget the I want to hold it for 3 to 5 years mindset. Now, that doesn't mean to say that you can't hold a stock for that long, but I would lose the mindset, the automatic assumption that no matter what the price does, I'm just going to hang in there, because there's going to be a lot of occasions where it's not going to work out very well. From my perspective, and I've been, I guess, progressing to this mindset myself over the last few years, is that any stock is purely a vehicle to make money. That's it. Pure and simple, that's what we buy it for. We don't buy it because we love it, or because it's our favourite retail commodity. We want to buy it as investors and traders to make money. And I think a lot of people confuse those two things. So I would strongly advocate that you build a game plan around making money out of any investment. Now, I've had a couple of questions lately about Vulcan Minerals, which Australian investors would know went up nearly tenfold in a very short period of time, and has had a lot of media attention. And the questions were largely around seeking certainty that Vulcan Minerals technology was actually going to make it. And my response was, well, look, it's going to be probably 2, 3, 4 years before we find out. So who cares? Don't worry about it now, because we're not buying it now to hold for the next 3 to 5 years. We're buying it now to make some money. So just build a game plan around how can we make money out of the fluctuations of Vulcan Minerals or any other stock that you want to name. And that's the mindset that I think is going to help you enormously in the market. So don't fall in love with anything, because what happens when you fall in love with something is that it makes an assumption that everything's going to work out well. Now, in many cases, if you're only dealing with megatrend stocks, that will be the case. And, we're going to have some tremendous outcomes. But not all of them will succeed, and there's going to be some that are going to hurt you badly. And if you go in with a long-term mindset that I'm just going to buy and hold, then I don't think it's the best mindset to have. So hopefully that big picture will just help adjust the mindset of a lot of people watching this video. So before we go to American stocks, let's just have a look at the Bitcoin chart. All right, we've had a big breakout which occurred in early February, and we got to an excess. So we broke out around $40,000. We got to a peak of $58,000. Now, when you've had such a breakout and a surge, you get a correction. Now, sometimes that correction is just one leg down, and then it goes up again and sets new highs. But when you've had such an excess, it often plays out as an ABC correction. And the reason that it does that, and this is not a prediction, this is just an observation about how psychology works. So there is the first leg down. So there's a degree of selling off as the smart money bails out and takes some profit. And then we get a secondary reaction back upwards because there's a bit of disbelief that the party's over. And so the markets rebound to a degree and often set a lower high. But then that runs out of gas, and we then get the completion of the correction in the C leg down. Now, I'm not saying that this is how that's going to play out, but these are the signposts that I would watch for. And all the important information is contained in this leg here, this B leg here. It's all about how does the price bounce. If the price bounces robustly with long-range candles, so the candles are big on a daily basis and there's good volume behind them, and they close near their highs, then it's more probable that this is just a one leg down and then a bounce. But if this is a really weak rebound with small range candles, indecisive, lots of long wicks on the top and the bottom, then you can expect that we'll get another leg down. And we could end up going back down to the very low 40,000 area again. So that's how I see Bitcoin playing out, purely on the basis of how human psychology works. Oh, one other thing I will look at while we're here is, let's just look at the VIX. So the VIX index spiked at the end of January, and we're getting these spikes more regularly now, which goes back to what I said at the start about the excesses in the system in all asset classes are being stretched unbelievably by what central banks are doing. So we saw a spike almost to 40 on an intraday basis back in late January. That caused a little bit of a sell-off. We then plummeted back down and actually went under 20 on an intraday basis. And you can see what happened in the last week with bond yields moving up above 1.6, that the VIX index has gone up again and got up to 29. So we're certainly back in a period of a bit of concern in the market, if you like. All right, let's look at American stocks now. The S&P fell 2.5% across the week. Now, nothing has shifted in terms of the trend yet, but I'm certainly open, whilst I'm absolutely convinced and convicted that we're in a secular bull market that runs on now for quite possibly another decade or even more. I am open to sharp corrections at any time. And bond yields are really the issue now short term. And they are leading equities. They led equities last week, and I think they're going to continue to lead equities. And every small move in the bond market is going to see the equities market do that on an intraday basis. And we saw that on Friday. Bond yields went up, equities went down. This is on an intraday basis. And when bond yields went back down again, as they did, then equities went up. So there's almost a perfect correlation between the two. And it's a real guessing game at the moment. What the market is doing, 1.5% yield on the 10-year US Treasury is not an issue. Money is not going to suddenly start flooding out of equities and going back into the bond market because the bonds have got to 1.5. The gap is still very real. The value equation is still in favour of equities. But what the market is trying to guess is this a trend that's going to continue at the rate that it's done in the last couple of months? It's trying to forward guess what's going to happen with bond yields. And no one knows that because it's just market forces. Central banks are holding rates down. They've said they're going to hold rates down even if inflation gets out of control. But the fact is, in the real world, yields are going up. So that's the unknown, and that's why you need to be flexible and open-minded with the short-term direction of equities. Now, having said that, that's in the short term. In the longer term, if you look at history, and I don't know whether history is such a great guide anymore because all asset classes are so distorted, but history would show you that when interest rates start to rise and bond yields start to rise, that it's generally a good thing for equities for at least a couple of years until it narrows the gap between the return you can get on bonds and the return you can get on equities. So the rising bond yields are typically good. So I think once, if the market gets a sense that bond yields are not going to continue to rise and all of a sudden just go on this massive tear up to 3 or 4%, then I think you'll see equities continue to do reasonably well. Certainly the mega trend area of the market will. But the other alternative is also possible, and that is that bond yields do continue to rise sharply, and I think that will see an overall sell-off in the market. And the US dollar turned up. It's now seems to have formed a base, and maybe Friday was the start of a reversal back up in the US dollar, and that corresponds with the fact that the 10-year yield is now pushing upwards. So, money is now going back into America, back into the bond market, because it's offering a better alternative. So the 10-year yield peaked at 1.6. It closed down on Friday intraday and closed at 1.42. But it's still a significant uptrend on where we were, let's say, August, September of last year. And of course, the VIX, as I showed you, spiked up to 28. So let's look at some charts. So we'll start with the S&P. So you can see we had a sharpish sell-off at the end of January when bond yields spiked and the VIX went up. And then we've just had another one. So we're back to the 50-day. Now, at the moment, there's no evidence that this is going to get into something bigger than what it is, because this looks exactly the same as this, and it only lasted a few days and then went back up again. as the markets settle down. But it certainly bears watching. So the S&P is sitting on the 50-day, but you can see the 20-day is still comfortably above it, the 50, then the 200. They're all lined up beautifully. So at the moment, the main US index is still okay. If we look at small caps, again, nothing terribly dramatic. We've only gone just below the 50-day, and Friday was a pretty indecisive day. So nothing terribly to get concerned about there, although Thursday was a sharp sell-off on bigger volume. If we look at the NASDAQ, it's been a bit of a bigger move. In fact, the NASDAQ was down about 4% for the week, as opposed to the S&P. So certainly we get more selling. And that was really about the theme of big technology stocks are going to do worse in a rising interest rate environment. And that's conventional wisdom. But I think that's only a short-term impact. I don't expect that it'll be very long. And the bargain hunters will move back into the Amazons and the Facebooks and the Microsofts, and this sort of short-term situation will be seen as a bit of a blip. Now, if we look at the US dollar, you can see we've been falling now for some time. We peaked out at 102 in March of last year. We've fallen all the way to this key support, and we now seem to have formed a base. And that base has actually now got a slightly higher low. And you can see the move on Friday was pretty good. So it's possible now that we see the US dollar have a bit of a rally. Now, it might only rally back up into the mid-90s. Not talking about a major change of direction here. But I think we've got a base, we've got a higher high, we've got a higher low. And so therefore we might continue to see the US dollar move higher. And, that's certainly not good for gold, which I'll get to next. Now, if we look at the Australian dollar, there was a sharp reversal. We almost got to 80 cents. In fact, I think we did get to 80 cents on an out of market reading during the week on Thursday. But then we got a sharp sell-off on Thursday, and then a big gap down and sold down very heavily on Friday night, and you can see the volume really picked up as well. So the Australian dollar is reversed sharply. So you would think that there's probably going to be some follow through on that as well. So let's just look at the ASX 200 while we're here, and you can see quite a bit of selling on Friday. There was quite a bit of selling the previous Friday as well. So I think we were down about 1.5% on the week as a whole. So the Aussie dollar, I think, just touched 80, but closed 76.65. The index, we were down 1.8. It's hard to know what will happen on Monday in our market. Certainly some froth is coming out of the speculative trades. And I think a lot of the top 100 copped a lot of selling. I think a lot of that was overseas selling from institutions trying to front run the opening of the US market. So it's pretty hard to anticipate how things might go tomorrow. From my perspective, the safest, most productive place to be on a adjusted risk for reward is small cap megatrend stocks. Now, yes, they're volatile and therefore not suitable for all investors. But if you want to make a really good solid return with the highest degree of probability, okay, you're going to have to put up with volatility. But it's these small cap stocks that are firmly entrenched in the megatrend areas is where it's at. Turning now to precious metals, gold sharply lower, lost $40 across the week, down to $17.34. We've actually now got a breakdown in gold. Silver continuing to outperform. Silver held up pretty well, as we'll see. Now, gold intuitively should be doing well. We've got inflation threatening to break out. We've got stresses in the system, left, right, and centre. So it would be logical to think that gold should be doing well. But, guess what? Logic has failed again. And you've just got to follow the charts. It's so starkly obvious that if you do things that are logical, that A, connects to B, connects to C, then a lot of the time you're going to be wrong. You've just got to follow the charts and respect what they're telling you and be open-minded to what they're telling you. So with reflation well and truly underway, and there's no question about that, you've only got to look at the copper charts that we'll look at next, that gold should be doing well, but it's not. And it was quite a significant technical breakdown at the end of last week. Now, look, bond yields are an issue, so gold doesn't do as well when bond yields are rising because the bond yield is paying people something positive, whereas gold doesn't pay a return. So therefore, gold becomes less attractive. So I think that's part of that. The other part of it is that equities have been so strong that people haven't sort of been looking for safe havens. So the need for safe havens has sort of gone out the window to a degree. But look, we could speculate all day about why gold is breaking down. It's not really relevant. It's not important. The fact is that it has, and we've now got to look at the chart and ask ourselves, what is the chart telling us, and not try and analyse it from a fundamental point of view. Now, if we look at precious metal stocks, gold stocks also broke down. They've been looking a bit iffy for a few weeks now, and they've broken down, and they're likely to fall further. Now, I'll give you a bit of a roadmap, as again, not as a prediction, but purely as signposts that you can look at to determine what is likely to come next. But I think the next few months for the sector looks a bit grim, is my overall view. So I would encourage you to examine the level of exposure you've got to precious metals for the next few months at least. And if you are heavy on precious metals, then you might experience a fair bit of pain in the next few months. So I would just consider your exposure, because it's possible that we could, with this breakdown now, have quite a sharp fall from here. So let me get on to the gold and silver. We'll start with the silver chart first of all. So just remember this chart. So we're held up very well. The 200 is still rising. The 50 is still rising and not closing the gap at all. And the 20 is also still rising and not really closing the gap. So silver is still very strong. Now, okay, it's been in a big consolidation since August, but at least it's consolidating near its highs. If you look at gold, I'll look at the daily first of all. So look at the orientation of the moving averages on gold. There's the 200 is the red line, the 50 is the blue line, and the green is the 20. Look at the orientation and then where the price is compared to silver. It's absolutely chalk and cheese. So if you want to be in the precious metals market, you want to be in silver. There's no question about it. And then we compound that by the fact that on Friday, gold has broken an important support level. There's no question, and it's broken it with a pretty big candle as well. Now, let's look at the weekly chart. So let's pan back and take a big picture view. This is the peak in 2011, and then this was the recent peak that we saw in August of last year, which went to a new high around 2080. Now, from 2011, we fell into a significant bear market that bottomed in November of 2015, so 4 years. And if we and one thing about the gold market is that it tends to be best analysed from a chart perspective than a logical fundamental perspective. You just always seem to get a better answer. And also gold seems to respond very well to Fibonacci retracement levels. I don't know why that is. It just is. So I'm not arguing against it. I'm just telling you what I observe over many, many years. That Fibonacci retracement levels seem to play a very strong part in the movement of gold and where gold is going to reverse. So if we take our Fibonacci retracement from the recent peak in August of last year down to the December 2015 lows, we get 3 possible reversal points. So there's no question now we're now in a downtrend. in gold. And you can see that we've dropped out of this strong trend channel that applied from November of 2018. So we shot above it to form that excessive high in August of last year, and now we've dropped out the bottom of it as well. So we've definitely got a breakdown, and we have also taken out these lows from November, December last year as well. So there's no question, lower highs, lower lows, we've got a downtrend. Now, these are the important areas to look for. The first retracement level of significance comes in at about 1688. The 50% retracement comes in at 1566. And the third retracement comes in at 1447. Now, intellectually, I find it hard to swallow that gold will go all the way down to 1446. But I wouldn't write it off. But I think it's a low probability. Certainly, the 38.2 or the 50% levels are absolutely in play. And as I analysed with the Bitcoin chart, it all depends on the nature of the bounce. I think people are going to be stunned that gold broke down from this 1790 level on Friday. And so as a consequence, we'll probably get some follow-through selling, possibly down to this 1690 level. And then I think we'll get a bounce because, people are they don't want to believe that the party's over. They want to believe that, gold is going up, the true gold believers. But it is the nature of this next bounce from wherever it comes, whether it comes from here or whether it comes from down here. It's the nature of that bounce that you need to pay attention to, because that will then tell you whether we're going down again further. So they're the signposts to watch for. 1688 and 1565, and then the nature of the bounce that follows a reversal from those levels. I think long term, as in the next 5 years, I think gold goes up significantly, but that is just, again, that's an intellectual assessment, and I certainly wouldn't trade it on that basis. But I think in the short term, the overwhelming odds favour lower prices in gold. Silver seems to be holding its own quite well, so you'd probably want to orientate towards silver at the moment because of the industrial demand. Now let's look at stocks. What did stocks do? So this is GDXJ, which I think is a better reflection of what's going on in the gold market. This was an important support level because it picked up all these peaks through here and these lows through here, and we broke it on Friday. So I think we're going to see more selling in gold stocks in the coming weeks. So that's the gold market. I must admit I'm surprised by it, but I know enough to respect the charts and what the charts are telling me. Let's look at other commodities. Copper continues to roar up, got to $4.19 and has really accelerated in the last week. So the turnaround in the US dollar might put a bit of a bucket of water on that. And nickel finished at 846. Just look out for the US dollar reversal if we get follow through to the upside, which I think looks at least a distinct possibility. But look, we've got a long-term trend in play now with base metals and with some other commodities. And that's all there is to it. I think we're in perhaps a period of maybe through to 2025 where commodities are going to do quite well. It certainly fits with the economic cycles. Now, crude oil also went higher as well, and this is a real complete head scratcher for me, with the way that everybody is so against fossil fuels. But nevertheless, it did go higher to 61.5. It spiked just above 60 last week, as I reported, but this week it actually closed above it. So it's confirmed that move. And as I said last week, the only thing that makes sense to me about the oil price going up is that production is not increasing, and demand growth due to the reflation trade, the stimulus of global economies, means that prices are going up, not because people are necessarily bullish on oil. It's just that production outlooks are worse than the demand growth, and therefore It could run further, but it's probably not a long-term trend. There's the spot copper chart. You can see we've moved from $3.50 at the start of February to $4.20. And whilst you can't see it very well, I think this actually did get to about $4.25 on Friday intraday before it turned down. But certainly copper, there's no question that's really strong. And if we look at it on a 5-year chart, you can get a sense of just how strong the copper rebound has been. So if you argued that this plunge during the initial COVID situation was just a bit of an aberration, that the price shouldn't have broken 250, but we've still moved from 250 to 420. It's still been an extraordinary move, and I think it's about the central bank stimulus, which is just extraordinary. All right, nickel, something similar on nickel. Again, we turned down a bit at the end of last week with the US dollar turning up, but nickel is still tracking very, very strongly. So to wrap it all up, there will be corrections, as I keep saying. Whilst I'm very bullish long term, secular bull market's still in play for another decade at least, there will be corrections, and they're going to be sharp. Hopefully they're not as abrupt as what we saw in March last year, but there will be corrections. So unless you are truly, really truly a long-term holder, and again in my experience of nearly 20 years, hardly anyone really is. A lot of people say they are, but most people really aren't. Then I think a more active and more flexible approach to trading and investing will be a huge benefit for you, because it's great to go in to a period of correction saying, yeah, no, that's fine, I'm a long-term holder. But the reality is that most people panic and sell somewhere near the bottom. And that's generally the worst time to do it, because then when you've done it, it's then incredibly difficult to get back in until you get your confidence back. And guess where you get your confidence back? When the market's gone up for a period of time and everyone starts to talk more positively. And not only have you crystallized a loss, but you've then removed the opportunity to make those big rebound gains. So I think a more active and flexible approach is just such a huge asset to have. Now, the collapse in bonds and the rise in the yields, if it continues, changes the game. There's no question about that. But I'm not convinced that it will continue. But I'm just playing it day by day. I've got a game plan on an individual stock basis for what I'm doing, and that's all I'm concerned about. It's so important to get the emotions out of what you're doing. Just respond to what the price charts are telling you. And if it conflicts with what your bias is or what you think should logically happen, then go with the charts. And you've just got to find a way to park what you think should happen, because it'll cost you heavily. Now, portfolio analyst last week, there was a huge number of questions, and as a result, I think there's an enormous amount of very valuable real market education in that, both from a fundamental and technical point of view. So if you're looking to upgrade your skills, then I think you could do worse than look at portfolio analyst if you've not taken that $1 trial. And also there was some portfolio changes that were required, and also a few portfolio reviews as well. So it was a pretty good session last week in portfolio analyst. All right, that's it for this week. There's my email address and website address where there's more information. And look, I'm sure it's going to be just another fascinating week, and I'll be back with you next Sunday. Cheers.